What if the single retirement account decision you make today could either save you tens of thousands of dollars in taxes or cost you that exact same amount down the road? That is not an exaggeration. Choosing between a Roth IRA and a traditional IRA is genuinely one of the most important financial decisions you will ever make. And the wild thing is, most people just pick one without actually understanding the difference. Today, we are going to change that completely. By the end of this video, you will know exactly which account fits your situation, why it fits, and how to think about this decision like someone who actually understands money. So let us get into it. Before we dive into the comparison, let us make sure we are starting on the same page. An IRA stands for Individual Retirement Account. It is a special type of investment account that the government has designed specifically to help everyday people save for retirement. The big draw is that IRAs come with serious tax advantages that your normal brokerage account just does not offer. There are two main types of IRAs that most people will encounter: the traditional IRA and the Roth IRA. They are both powerful tools, but they work in very different ways, and understanding those differences is what separates people who retire comfortably from people who wish they had made smarter moves earlier. So let us start with a core concept that separates these two accounts, and that is the question of when you pay taxes. With a traditional IRA, you contribute money before it gets taxed. Think of it as a tax break right now. You put money in, and depending on your income level and other factors, you may be able to deduct that contribution from your taxable income this year. Your money then grows inside the account, and you do not pay taxes on that growth while it sits there. However, when you eventually pull that money out in retirement, you pay income taxes on every single dollar you withdraw. The government has been waiting patiently this whole time, and retirement is when they finally collect. The Roth IRA flips this completely. You contribute money that you have already paid taxes on. There is no upfront tax deduction. You are putting in after-tax dollars. But here is where it gets really exciting. That money grows completely tax-free inside the account, and when you withdraw it in retirement, you pay absolutely zero taxes on it, not a penny. The gains, the interest, the dividends, all of it comes out clean when you retire. Now you might be thinking, okay, but which one is actually better? And here is the honest answer. It depends entirely on one critical question. Will your tax rate be higher now, or will it be higher when you retire? That single question is the key to this entire decision. If you are early in your career, you are probably in a lower tax bracket right now than you will be in 20 or 30 years when you are at your peak earning potential, or when tax rates in general might be higher. In that case, paying taxes now at a lower rate and letting everything grow tax-free inside a Roth makes a lot of sense. You are essentially locking in today's lower tax rate forever. On the flip side, if you are currently in a high-income bracket and you expect your income to drop significantly in retirement, then the traditional IRA might serve you better. You get to defer your taxes until you are in that lower bracket, which means you end up paying less overall. This is the classic tax arbitrage play, and it is a legitimate strategy for people in higher earning years. Let us talk about early withdrawals, because this is where a lot of people get tripped up. The standard rule for retirement accounts is that you cannot touch your money without penalty until you reach the age of 59 and a half. That applies to both account types. However, the Roth IRA has a feature that makes it uniquely flexible. Because you already paid taxes on your contributions before putting them in, you are actually allowed to withdraw those original contributions at any time, without penalties and without owing taxes. The key word there is contributions. The gains and earnings your money has accumulated are a different story entirely. Try to pull those out early, and you will face taxes and potentially a 10% penalty. But the ability to access your original contributions gives the Roth a level of flexibility that the traditional IRA simply cannot match. With a traditional IRA, early withdrawal means you are going to owe income taxes on whatever you pull out. Plus, in most situations, you are also hit with that 10% early withdrawal penalty from the IRS. It is a double hit that can really sting. This is one reason some people use their Roth IRA almost like a backup emergency fund. We want to be very clear, though. Ideally, you are building a separate emergency fund in a high-yield savings account, and you are leaving your retirement money alone to compound. But if life gets difficult and you need access to funds, the Roth gives you an option that the traditional IRA does not. Here is another major difference that people rarely think about until they are actually in retirement, and that is required minimum distributions, or RMDs. With a traditional IRA, the government mandates that you start withdrawing money at a certain age. The reasoning is simple. Because you never paid taxes on that money, the government cannot let it sit in your account indefinitely. They need to collect at some point. So they force you to take out a minimum amount each year once you hit the required age. These mandatory withdrawals can push you into a higher tax bracket in retirement, potentially affecting things like your Medicare premiums and the taxability of your Social Security benefits. The Roth IRA has no required minimum distributions. None. You can literally let that money grow for the rest of your life and pass it on to your heirs if you want to. This is a massive advantage if you do not necessarily need the money in retirement and you want to maximize what you pass down to the next generation. The absence of RMDs also gives you far more control over your tax situation in retirement because you choose when and how much to withdraw, rather than having the IRS dictate it to you. Now, let us talk about income limits because this is where the Roth IRA has a significant restriction. Anyone can open and contribute to a traditional IRA regardless of how much money they make. There are no income ceilings. The Roth IRA, however, has income thresholds that can prevent higher earners from contributing directly. The original idea was to ensure that the tax-free growth benefits of the Roth were available to everyday working people, rather than exclusively benefiting the highest earners. If your income exceeds the threshold, your ability to contribute to a Roth directly is phased out or eliminated entirely. So if you are a high earner, make sure you check the current income limits before assuming you can simply open a Roth and start contributing. Now for the things both accounts share, because there are some important similarities worth highlighting. Both traditional and Roth IRA as offer tax-free investment growth while your money is sitting in the account. Whether you pay taxes before or after, the growth itself is not taxed annually. This is a huge deal. In a regular taxable brokerage account, every time you sell an investment at a profit or receive a dividend, you owe taxes on that event. Inside an IRA, your money compounds without those annual tax interruptions. Over decades, this makes an enormous difference in how much wealth you accumulate. Of course, the tax structure is only half the equation. The other half is the actual investment decisions you make inside these accounts, and that is where most people quietly lose money over the years. Which is exactly why I want to put VI Palgos on your radar. It is a premium suite of AI-powered TradingView indicators built to take the guesswork out of market analysis. Instead of staring at charts trying to interpret every move, VI Palgos gives you clear visual alerts, trend direction, and clean setup zones across stocks, crypto, and Forex. For long-term investors and active traders, that means more structured entries, fewer emotional decisions, and a real framework for protecting your capital. If you want smarter, more confident investing, click the link in the description below and check it out. Better decisions inside the account multiply everything the tax advantages are already doing for you, and that compounding effect is exactly why the next point matters so much. Both account types also share the same annual contribution limits. The IRS sets a cap on how much you can put in each year across all your IRA accounts combined. If you are 50 or older, you get an additional catch-up contribution allowance on top of the standard limit. You also need to have earned income to contribute to either type of account. You cannot fund an IRA with passive income or investment returns alone. So, how do you actually decide? Here is a practical framework. If you are young, earlier in your career, and in a relatively low tax bracket, lean toward the Roth. You are paying a lower tax rate now, your money has decades to grow tax-free, and you will thank yourself immensely when you retire and pull out hundreds of thousands of dollars without owing a single dollar in taxes. If you are in your peak earning years in a high tax bracket, and you expect your income and therefore your tax rate to decrease in retirement, the traditional IRA makes more strategic sense. Take the tax break now when it is worth the most to you. And if you are genuinely uncertain about your future tax situation, which is honestly most of us because predicting future tax rates is not easy, some financial advisors suggest contributing to both types of accounts if you are eligible. This is called tax diversification. Having money in both pre-tax and after-tax buckets gives you flexibility to manage your tax bill in retirement by strategically choosing which account to draw from in any given year. The bottom line here is this: both the Roth IRA and the traditional IRA are genuinely excellent vehicles for building long-term wealth. The best one for you is not about which sounds cooler or which your friend uses. It is about your specific tax situation today versus what you expect it to look like in the future. Think carefully about where you are now, where you are headed, and let that guide your decision. And regardless of which one you choose, the single most powerful move you can make is to start as soon as possible. The longer your money sits in these accounts compounding year after year, the more financially powerful your retirement becomes. So here is my challenge to you. Drop a comment below telling me whether you currently have an IRA, which type you have chosen, and what factored most into your decision. I genuinely want to know, and your experience might help someone else watching this video figure out their own path. If this video helped you understand these accounts more clearly, give it a like because it really does help this content reach more people who need it. Subscribe to the channel if you have not already, and hit that notification bell so you never miss a new video. There is a lot more content coming on retirement planning, investing, and building long-term financial freedom. See you in the next one.